Welcome back, everybody. Well, it's a very interesting time, isn't it? Last time, I said the anticipation is killing us, in that we've been stuck in this below-than-average deal volume market for 3 years, and we've been just waiting to break out of it. And we were starting to, as in past tense we were, and yet we still are-ish. It's the momentum that we seek. But it's always something, some speed bump. It's like Groundhog Day, it keeps repeating itself. And again, the trend has been that we are succeeding in breaking out of this. You know, the whole thing reminds me of Michael Corleone. Do you remember when he says, just when we thought we were out, they pull us back in? And this time, it's tariffs. Every time we start to see the light and the prospects of some substantial market activity, we encounter some sort of speed bump or landmine. And tariffs are the grenade that someone just threw into our economy. So are all bets off? Or are we seeing just another pause due to uncertainty? Or is it about new bets? You know, the silver lining in this right now is really low rates. But at what cost? The biggest hurdle for the past 3 years has been the elevated mortgage rates, which was brought on by inflation. The good news was that the Fed's goal was to bring them down in a measured way, which they were achieving, albeit a little bit slower than we would have liked. But now, with Liberation Day, the rate declines have accelerated. But for all the wrong reasons. Now, they're declining because the global economy is in shock and investors are trying to find safer places to put their money, like US Treasuries. And when that happens and demand increases for those Treasuries, the prices go up, but the rates come down. And then the mortgage rates follow. This dynamic presents an interesting moment. Interest rates. The one metric that has been holding the real estate market back for those 3 years, for both buyers and sellers, is loosening up and creates a more favorable buying opportunity. For now. Because we have to note there's an opposing force, which will start to mature itself into our equation in these coming months, which could completely erase the positive step we've taken with lower rates and instead send the rates higher in the other direction. And the reason this could happen would be that if inflation indeed intensifies again. The extreme nature of these tariffs has a lot of economists predicting substantial inflation. And as everyone knows, the Fed does not drop rates in the face of inflation. If inflation becomes extremely extreme, it could prompt the Fed to actually raise rates. Then what? We would be back into the same cycle, and this time, if things got bad, it could happen in the midst of a recession. Also, what history has taught us over and over again is that such moments create extraordinary buying opportunities. Now, these factors always affect the buying pool differently. The wealthy will do, well, what the wealthy does, and they take advantage of every possible buying opportunity. That said, this particular financial event even caught them off guard, leaving most of those all-cash buyers with a little less liquidity than before. And the proletariat, for lack of a better term, they may actually find their buying opportunity now in this little window of low rates, because these people are far less affected by stock market plunges, and they may see things loosen up for them now, until, well, rates go up again. If they do. It's hard to predict. But with rates in the best range that we've seen in a while, it's likely worth exploring the opportunities that are actually out there right now. So I have a question for you, and I really would love to hear your thoughts on this. 1. Will the US's rigid policy regarding these tariffs prove hubris, and in turn hurt us in the global economy as countries lose trust in us and seek out other alliances? Or will it actually prove to be successful? And if so, when will we know that? I'd love to hear from you. Is it 1 or 2? In the meantime, have a great spring.